Today, we need to have a very honest conversation, the kind you would have with a friend over a cup of tea. It's late Jan 2026, and if you look at the headlines coming out of New York or Mumbai, it feels like a never-ending party. The S&P 500 is hitting record highs. The Nifty is trying to keep up, and your social media is probably flooded with people who think they have mastered the stock market because their portfolio is green. But there is a famous saying in the markets: the loudest music plays right before the lights go out. I'm not here to scare you or play a doom and gloom character. I'm here because the math is starting to look dangerous. We are seeing a concentration trap where only 7 to 8 stocks are carrying the entire weight of the world's economy. I did not say US, I said the world's economy. Think of it like a giant building standing on just 2 thin pillars. If those pillars crack, the whole thing comes down. We are going to peel back the layers. We will look at exactly why the US market is at risk, the check engine lights that are flashing red right now, and how you can prepare so that a crash becomes an opportunity for you rather than a disaster. The biggest reason the US market has been rallying: artificial intelligence. For last 3 years, we have treated AI like a magic wand. Every time a company mentioned AI in their earnings call, their stock went up by 10%. But we have now reached what I call the AI monetization cliff. In 2024 and 2025, it was okay to spend billions of dollars on NVIDIA chips and data centers because we were building for the future. But now in 2026, the biggest institutional investors are starting to lose patience. They are asking the management a very simple question, Indian style question. Bhai, revenue kahan hai? If these tech giants can't show that AI is actually increasing their profits and not just increasing their electricity bills, we are going to see a massive multiple de-rating. This is exactly what happened in dot-com bubble of 2000. People weren't wrong about the internet being the future. They were just wrong about how much they should pay for it. If the AI bubble bursts, it won't just be a tech problem. It will wipe out trillions of dollars in market cap, causing a liquidity vacuum that will suck the life out of every other sector. While we are busy looking at stock charts, something much scarier is happening in the background: the US national debt. As we speak, the US government owes over 38 trillion. To put that in perspective, they are now spending more money just to pay the interest on their debt than they are spending on their entire military. For decades, the world didn't care because the interest rates were zero. But today, with rates being higher for longer, the US is basically using one credit card to pay off another. This is a trust crisis in the making. If global investors start to feel that the US dollar is no longer the safest asset, they will demand higher yields on US bonds. When bond yields go up, stock markets almost always go down. Why? Because if I can get a guaranteed 5% or 6% return from the government, why will I take the risk on a tech stock trading at 50 times its earning? This shift of money from risk to safety is usually what triggers the first leg of a market crash. It starts slowly, like a leak in the dam, but once the crack widens, the water comes out gushing. There is a specific date I want you to mark in your calendars: May 2026. This is when Jerome Powell as the Fed chair comes to an end. Now, why does this matter to an investor in Pune or Bangalore? Because the Federal Reserve is the world's central bank. For years, Powell has been the adult in the room, trying to balance inflation and growth. But with new leadership transition happening in a politically charged environment, the market is terrified of policy missteps. If the new Fed chair is seen as too weak or too political, the market will lose its anchor. Historically, leadership changes at Fed during the times of high debt have always led to massive volatility. Markets hate uncertainty more than they hate bad news. If a market feels that the Fed has lost its grip on inflation or the economy, the algorithms which control 80% of the trading today will trigger a massive sell order in milliseconds. This is how a normal correction turns into a flash crash. Now you might ask, how do I know the crash is actually starting? You don't need to be a financial genius. You just need to look at the big boys. Gold. In late Jan 2026, gold has shattered records after record. After crossing 1,75,000 per 10 grams in India, why is Sona shining so bright when the stock market is supposedly doing so well? It's because the world's central banks and the smartest hedge funds are buying insurance. They are hedging their bets. Another huge sign is the Buffett indicator. Warren Buffett is currently sitting on a cash pile of over $380 billion. Think about that. The greatest investor of our time would rather keep his money in boring cash than buy stocks at these prices. He's essentially waiting for the crash. When people who own the market are selling and the people who have never traded before are buying, that is the ultimate sell signal. If your taxi driver or your neighbor is giving you the hot tips on small cap stocks, it's time to be very, very careful. A lot of people think if the US crashes, why should I care? Indian economy is strong. And they are right. India is a bright spot. But in a globalized world, money flows like water. When the US market crashes, global investors, the FIIs, face losses in their home country. To cover those losses, they sell their profitable investments elsewhere. And where do they have the most profit? India. If a 30% crash happens in the US, don't expect India to stay green. We might see a 15 to 20% correction here simply because of the forced selling. The good news is that because of our fundamentals, we are in a strong position and we will recover faster. But the crash phase will be painful for anyone who's over leveraged. If you are trading on margins or have taken loans to buy stocks, a 20% drop will wipe you out before the recovery even begins. This is why survival is more important than returns in 2026. So what is the final word? I'm not telling you to go and sell everything tomorrow. That would be foolish. But I'm telling you to build an umbrella before it starts raining. First, check for 200-day moving averages for every stock you own. If a stock is trading below that line, it means big players have already left the building. Don't be the last one out. Secondly, raise your cash levels. Having 20% of your portfolio in cash isn't missing out. It's keeping your weapons ready. At least take the inspiration from Warren Buffett. When the crash happens, that cash will allow you to buy the best Indian companies at 2022 prices. And finally, please stop obsessing over the Nifty 50. Nifty 50 index is a mask. Look at your own portfolio. Stay disciplined. And remember that in the world of investing, he who lives to fight another day wins the war. Stay safe, stay factual, and I will see you in the next one. Thank you for your time and thank you for tuning in. Have a great day. Bye.